February 21st, 2024. Today we got a measure move down of this wedge from the 22 high to the 4 low, exactly where the low of the day was. And, it was a wedge 2, 7, 22, but it was also more than that. You can see that, I thought it was reasonable to buy at 21 and, take a chance we rally to, maybe the one low from the other day. But I thought it was reasonable to buy that. But I also, this is a breakout of the 18 bar range, right? Every day, 90% chance we're going to break out of the 18 bar range. And sometimes what will happen is if you get a breakout of the 18 bar range and within 5 bars, if you get a bull breakout of the 18 bar range within 5 bars, if you get a bear bar closing near its low, traders will sell it hoping for a breakout to the other side. And that's kind of what we got today. Additionally, that, the market is always trying to get a measured move on the open. And we had a relatively tight open. So the bulls wanted to break out to the upside and measure move up above the wedge, something like this at that time when you see 21, right? They want something like this or a measure move up from these, or, once you get the pullback, they want something up here. And the bears wanted the breakout to fail and get a reversal down. So it's a failed breakout of the 18 bar range by 23 and a wedge. So I think it makes a lot of sense to exit longs below 23. Maybe you can sell small risk, which is good for the bears, but I would rather wait for a bar like 31. Bar 1, a bear bar, but not really a great close. It's essentially a failed breakout below this buy climax yesterday. We tried to break out below the low and get a strong bear bar closing near its low, and bears weren't able to do it. So disappointment on 1 and a bull bar, closing somewhat near its high on 2. It's triggering the high 1 above bar 1, but not a good buy above 1, especially after the gap down. We're probably always in short from the gap down, but not really a good buy anywhere up here. Probably sellers above 1. 3, a double top with 1. Theoretically a swing sell, but it's really not very good. It's a 3-bar tight trading range. You're selling way too low. After this gap down too, you want to see follow through. If you're going to sell this far below the moving average, keep in mind the moving average is the average price. So, you want above average bear price action to be selling down here. If R4 looks like 3, you can maybe consider starting to look to sell. But I don't really want to take the short right now. And that's how you get bad follow through on 4. Any bears who do sell 3, bears were more interested in selling a pullback of 3. They tried to sell around the 50% pullback, didn't get filled on 4. And then you can see if you sold 3 and you get 4, those traders are using the tail on 5 to exit their shorts around break even and causing the bounce on 6. Causing the bounce on 5. 6, a bear or a bull bar, but not really a very strong close. We have 3 straight dojis. There's tails on the tops and the bottoms of all of them, so it's a tight trading range. Maybe we get a measure move up. If we get a bounce, we end up getting a little bit more than that. And then you get a surprise on bar 7. Is 7 by the close bar? Not really. I think it's way too big. And if you look, I thought we were always in short on the gap, most likely, but the only credible sell signal we had today wasn't a good sell signal, but it was theoretically credible was bar 3. And right as it became always in short, right, like bar 3, you ended up getting bad follow through and reversal. So 7 is becoming always in long, but right as it's becoming always in long, what do you think is going to happen? We're probably going to get a pullback, and that's what trading ranges do. Right as it becomes always in short, on 12, we end up getting reversal. Right as it becomes always in long 21, we end up getting reversal. So it's harder to trade always in on trading range days like this. Disappointment on bar 8. As you might be expecting, if you're buying the close of 7, you get disappointment on 8. And 8 did something really important. If you bought during this, you were hoping the bears who sold the high of the day end up getting trapped. And you can see on 8, those traders, they bought those traders, they sold here, they scaled in higher, and they were able to get out during bar 8 with a profit on their first entry and around break even with a profit on their second entry around break even on their first entry. If you were watching bar 9 for about 4 minutes and 58 seconds of this 5-minute bar, it was an inside bar. What happened was too many people tried to front run it and get in at a better price, and then it ended up going below 8. And why is that a problem? Well, if you think about it, inside bars are just triangles on lower time frames. So like 10, if you just draw trend lines, you can visualize it, on 11, you can visualize that this is a triangle. And triangles are breakout mode patterns. So traders are hoping that this is essentially in breakout mode. If you get an inside pattern on, pattern on 9, you can see inside bar 8, hopefully inside bar 9, it's even more contracting. And the market's, in these situations, it's like a spring. when it contracts, it can burst out in either direction. So traders were hoping to catch a big breakout, but we ended up trading below 8. And when we trade below 8, now all it is a low one short below 8. And there's a big tail in the bottom. And you have this big, these 3 bull bars, but really this big bull bar 7. That's probably going to get a second leg up. So that makes the sell on 9 not very good. And that's why you didn't end up getting very many sellers below there. Traders, in fact, ended up just, exiting their shorts, being disappointed in how this went. Probably better to sell above 9 than below 9. You can see bulls got potentially their second leg up on 10, 1, pull back 2. Inside bar on 11, a doji bar in a tight trading range. It's a second entry sell for the bears. But my problem. So first off, you had your inside bar on 11, and then you have a big bear bar closing your low on 12. Do you want to sell 12? Well, you probably can, but it's one of those things where as it's becoming, always in short, you're probably going to end up getting bad follow through. And additionally, if you look at 11, if you bought below 11, you're buying kind of high in an overall trading range. So it's really not all that great, and it's a second entry short. So buying below 11 really is not ideal, meaning that less traders will take it, meaning that even with the big bear bar on 12, there might be a lot of traders looking to scalp out. Or sorry, there might not be as many trapped bulls looking to exit. So if you bought below 11, you can't be all that surprised when you get a bear bar, and you probably have to scale them lower. In addition to that, bears, if you took the sell below 11, which was dumb, but if you did it, you're probably pretty thrilled with bar 12. And a lot of those traders realized that we had big up on bar 7, and now we have big down on bar 12. So we might end up being in a more confusion type of state rather than a big bear trend. And, look at the follow through you get on bar 13. If you sold below 12, is 13 really ideal follow through? Not really. You probably needed another bar that looked kind of like 12 to convince traders we're going a lot lower. Instead, you get a more sideways follow through bar on bar 13. So a lot of traders are probably going to be looking to get out. And that's exactly what happens on 14. Traders sell 12, they're disappointed 13, and they just exit, at the close of 13 and end up making a small scalp. And that costs 14. 14, triggered the high one above 13. You could argue double bottom with somewhere over here, but it's really not all that great. It's a bear bar. Essentially outside down on 15. This is a tight trading range. It's a low one short on 15, but you're selling the low one, low in a tight trading range, low in an overall trading range with the tail. Not a good sell. It's also a third push down. 1, pull back 2, pull back 3. 16, a bull bar. It was a smaller bull bar for most of the bar, and I was hoping it would stay small, but ended up, traders ended up, again, front running it and ruining the bar the same way they did with 9. And so we ended up getting a bar, with a big tail on top, and just more disappointment, 17. Bears hoping that this is their spike, and this is a 2-legged pullback, and then they're about to get a channel down and a breakout below, the 18 bar range and a swing down. Bulls hoping that this is the bottom of a trading range and they're going to get some sort of reversal up. 18, a bear bar closing near its low, triggering the sell below 17, but 18, not a very convincing bar, tail on the bottom. It could go for a swing, but I think better to just wait. And bulls know that a lot of bulls might exit if we trade below 18, so they buy the close of the bar, and that causes all the rallying on 19, but probably sellers above the tight trading range, so we trade back down, and then a surprise up on 20. 20, again, was one of those bars where, for the most part, it was smaller, and it was looking like a potentially reasonable buy for a swing. And then in the last minute or two, it just ended up getting really big, and then it had a disappointing tail on the top, which is going to keep traders out. Some bulls bought the close anyways, and we got a micro gap up and a good follow through bar on 21. In an ideal world, 20 would close on its high, and you get a bigger, a bit of a bigger bar on 21. You want bars to, for strong breakouts to generally be similar sizes, and 21's just a little bit smaller than you want it to be, but I still think it's credible to buy above 21. You're buying a third push up, so you just have to be quick to get out. That's really it. You do have this open gap with the 19 high and the 21 low. And the bull traders who sold above this high potentially could get trapped if we continue to rally. If we rally quickly, but we don't. We get disappointment on 22. If you bought above 21 and you get 22, I think probably still okay to stay long. It's pretty sideways, but this is strong enough for a second leg. So I'm a bit disappointed in 22, but I'm still always in long, still want to stay long. And then you get an inside bar on 23, and it's tough to exit because it's such a small bar, and you're just hoping that you can, it'll be okay. But the reality is it's a wedge top, it's a failed breakout of the 18 bar range. You got to get out below 23. And if you get out below 23, there's a lot of ways you can buy it back. You could just buy back. What are you scared of? So exactly, if you're getting up below 23, what are you scared that's going to happen? This exactly what happened on 24 is what you're scared is going to happen. So if you get out below 23, what you can do is just put a buy stop to put your position back on if we trade above 23. Because if we go below 23 and then quickly start to race up above it, you'll get back in. And if it trades back above 23, it's much less likely that it's going to end up being a big bear bar closing near its low. So essentially, you can get rid of, by getting up below 23 and putting a stop order to get back in above, you can stay out when it does this, and you can get back in quickly when it starts to go your way. That's something I've been trying to do with always in trading is if there's a sell signal bar and I end up getting out below it, a lot of times I'll just put an order to buy my position back above it. So if it ends up going outside up, you can just get your position back. There's an example of this yesterday. I think here is probably another reasonable example of that. It was a second entry short, and it's not really a very good short. It's right on the moving average. But if you're long, you didn't have to get up below here, but you might have to get up below here, but you can just put a buy stop order back above it and re-enter. Or you can buy above any bull bar closing your tie here. This is more of an experimental idea that I've been using, and I think it's been working for me. So I'm going to continue to do it. But anyways, bear bar closing near its low 24 from bulls being disappointed and dumping out of their longs below 23. Follow through on 25, but starting to overlap with the 19 high. That the bears, it's kind of tough to sell 24. You're selling right on the moving average. It's a big bear bar, but you're selling after so much strength. We're probably going to get a higher low at some point because of how strong this is. Right on the 19 high, again, a breakout point. Bears who sold above the 19 high, disappointed in this, are going to scale in, and they're probably going to have a chance to get out around break even on their first entry with profit on their second because this is a trading range day. 26, bear doji bar. We do have 5 straight bear bars. So, bulls, when they see this and then they see this after 24, they're kind of hoping we get a good bull bar 25 and they can maybe put their position back on, keep these traders trapped because it didn't quite overlap with the 19 high. But you end up just getting, too many bear bars. 5 bear bars is way too many bear bars. And so traders are not really going to be interested in buying above 27. 28, a doji bar, it's an inside pattern, 27, 28. When you get IIs, unless it's in in situations like this, if you get an II, it's not a reason to just hit buy the market or buy directly above this. Here, if this had been an II, it's a little better because the context is good. It's higher up in the trading range. It's an II after a buy climax, so it's potentially better. But here, after so many bear bars, it's really not that good to be buying with the II. I would rather wait. A bull bar on 29, but let's see the follow through. If you're buying above 29, you need to be quick to get out. And I would rather just wait to see if 30 is another good bull bar. Honestly, these bars aren't that big either compared to the size of this breakout. So you might even need 3 bull bars to really be convinced. And then you get disappointment on 30. And the bulls who bought above 29, they see 30. What do? They exit their long at break even, and that causes the big bear bar 31. 31, it's a wedge, and then we got a lower high. So potential, pretty major trend reversal here. Good follow through 31. Good follow through 32, but a tail on the bottom. And then 33, another tail on the bottom, and a failed breakout to the downside of the 18-bar range. And it's easy. I think it's really easy to look at this, to see 31 and think, oh, we could go a long way here. And I think that's probably true. I'm also interested to see if we end up getting a measure move, this big bar somewhere. Maybe down here. Yeah, so look at that. There's a lot of magnets down there. A lot of times when you get a big bar, you just get a measure move bit. But it's really easy to look at 31 and think, well, maybe we're going to go really far. And it's possible, I think, on 31, but you have to keep in mind it's a trading range day. And there's been a lot of trading range price action. And so traders are, more prone to scalping out on these days quickly. And so when you get follow through on 32, it's good follow through, but there's a big tail on the bottom, which tells you that, this is a reminder that this is still a trading range. And traders see the tail and they're hoping for another bear bar closing near its low and then get another bear bar closing near its low. But they end up getting a tail 32 and a tail 33. So now it's a failed breakout below the low of the 18-bar range, and you have all these tails. So it is always in short, and it's okay to be short and just exit your short above 34. But ideally, you could just exit a big chunk of it at the low of the day and just look to sell again, because it's probably a trading range, and in trading ranges, traders are going to scalp. So I think a lot of bears will exit above 34, but bad follow through 35, not good to buy after so many strong bear bars. 36, a bear bar closing near its low. If you're always in, you can probably sell again below 36, but it's the bottom of the trading range. It seems really dangerous. Kind of bad follow through on 37, and a lot of traders who sold below 36, disappointed 37, are going to buy back their shorts. Probably bulls willing to buy below 35 and scaling lower. 38, another bull bar closing near its high, and then you get 39. And it's potentially 3 pushes, 1, pullback 2, pullback 3, or you could argue spike and channel, and then we're going to get a trading range. But if you're looking at 39, so if you're a bear and you're short and you're looking at 39, look at how strong 34 was, closing very near its high. 38 closing near its high. All these good bull bars. If the bears were going to get a swing down, they probably would have done it already. It probably would have gotten really strong bars here. So 39 too, if it's a bear bar closing on its low, maybe it's more reasonable to take a chance that we sell off. But the reality is it ends up, being kind of a disappointing close, and you're so low in what's probably a trading range where you've had so many strong bull closes. So traders are just going to probably exit at the market, and that's what causes 40 to get so big. Traders just start flattening at the market. Do you buy above 40? I wouldn't. I think you're buying too high in this tight trading range, and you get follow through 41, but really not all that ideal. You wanted, if you're buying above 40, you wanted to see another bar that was like 40, and then more follow through 42, but not all that great. Trader's not even able to make 5 points, and then they exit, causing the huge bear bar on 43. 44, it's a double bottom with 40, potentially 3 pushes. You could probably buy it above 44, but the upside's most likely limited considering all the trading range trading today and how big this bear bar is. We might have to get a second leg down from it. But bulls are able to make 5 points. You can see, look at the follow through on 45. There's a big tail, meaning that at this price, right, bulls bought the close of 42. It wasn't great, but it was 3 straight bull bars. So in theory, it was reasonable. And they're scaling in lower. This is a classic example of trading range behavior where you can't, you're not going to be, good at trading until you learn to, if you do buy above 40, you need to be buying more down here because it always runs bad stops. So you can't buy above 40 and put a stop down here and then just watch the market stop you out. You either need to buy, if you're buying above 40, you pretty much get out really, really quickly in here, or you need to add down here and then, scale in essentially. And it's really hard to scale in when you're, I'm really bad at scaling in. So I just don't do it. But it's really hard to do that. So most traders, again, that's why you should not take this buy. And look at 45. There's a tail on the top, right, where those traders, who were willing to scale in, bought more lower, and they're getting out. And then another tail on 46. And the bulls who bought above 44, able to make 5 points, but you get tail 45, tail 46, really not ideal to be long here. Disappointment 47, bulls scalping out. And, bulls hoping to get a bull close 47, don't get it. They exit 48, and we start to enter a tight trading range. There was some sort of FOMC announcement here, so I would just be flat through this. You need a bear bar closing near its low on 53, but you're selling the bottom of a tight trading range right near the announcement, so not very good. And then a big outside bar, 2 o'clock. I wouldn't take anything here. You should wait a couple of minutes. Inside bar, 56, but, higher in this trading range, really not all that great. Then a bear bar closing near its low, 57, which is a reasonable sell. 42, 46, and 55. So it's a wedge top. And you could take the sell for a swing, hoping, maybe we break below the bottom of the wedge. You have reasonably good risk reward. 58 is a bit disappointing. You can see the bulls who got the close of 56, disappointed. 57, obviously, they're very scared. And 58 traded up, and they were able to sell all the way longs at break even. I'm curious. I'm going to look at a 1 minute chart. So 210. I'm curious to see when it triggered. So we got to go to 210. So 210, and it triggered below. And then, okay, so it triggered first before it rallied. Interesting. Just wanted to look at that. So obviously the tail on 58 is disappointing. The tail on the bottom is disappointing, but a lot of traders will stay in. You can see 59 traded back to the 57 low, and then traders sold again. And then we got a big follow through on 59. But bulls are going to buy the low. Why? Because they bought the low, they made money. They bought the low, they made money. They bought the low, they made money. So that you bet they're going to buy the low again, and they're probably going to make money, which is exactly what happens on 60. Some traders, bears, may be taking profits. I don't know if it's around 2-to-1 of true risk. A little past it. So the close of 59 is 2-to-1 of true risk. On trading range days, a lot of traders scalp for true risk. 61, an inside bear bar closing near its low. You're going to sell below it. You maybe can. It's always in short, but just, risky. We could get a bounce at any moment here. Follow through 62, but tail on the top, tail on the bottom. Follow through 63, but smaller bars. It's a tight channel though. It should get a second leg. And then a bull bar closing near its high, 64. Do you buy 64? No, this channel is too tight. This is a minor reversal. And yeah, this channel is just too tight. You're buying low in a trading range today, so I get the idea, but you'd have to have a really wide stop for buying 64. Bad follow through 65, 66. Traders start to exit 67. A bear bar closing near its low. Always in bears, maybe sell again, but after 3 straight bull bars, kind of hard to do. Follow through 68, but smaller bar, and then a doji on 69. We're probably forming a trading range here. 70 outside down, and again, bulls, they bought this low, they made money. They're going to buy this low, and they're going to make money, which they do again. 70, 71. We're also, I thought because of the daily chart, we might be kind of primed for a move up. You see, we were basically trying to test the moving average, and this is a bad sell below. And you can see we tested below yesterday's low in here. And so I thought we might end up getting a bounce. I didn't think we were going to get this big of a bounce, but I thought we could easily get some sort of bounce and try to get a bull close. So you get 72 closing near its high. You are buying on the moving average essentially, but you're buying a bigger wedge, I suppose. 1, 2, 3. It's very messy, but that's how things are in trading ranges. I wouldn't buy above 71, but you get a good bull bar 72. You can probably buy taking a chance we rally quickly to the open of the day. And then you get a good follow through 73. It's buy the close. Good follow through 74. It's buy the close. 75 not closing above its midpoint, so it's not, but you could buy above 76. And then good follow through 77. To be honest, if I was long, if I had bought 72 or 73, and then I see 75 and it failed breakout of the high of the day, I would probably just look to take profits. And I think that's what caused the tail on 76. With some bulls, they had a pretty good profit and they, no true risk. So they just ended up exiting, and that's what caused the tail on 76. Then you get a big bounce on 77, but I think that it was probably okay to take profit somewhere in here. The daily chart, it's a high 2 for the bulls. So you had a high 1 here, high 2, double bottom, but I don't think it's really going to be all that effective. A couple good bear bars over the past couple days. I think we're forming a trading range right now, and we probably need to get a close below the moving average pretty soon here. So this is probably a pretty low probability trade. I'll be interested to see, pay a lot of attention tomorrow to what we end up getting above that bar. If we get like a gap down tomorrow, so this is going to affect the next day, tomorrow, obviously, or maybe the next couple. If we get a gap up, that could be the second leg up. But if we end up getting a gap down, especially to like the 50% pullback area, I would definitely start to look for a swing up, something like that. And get back above this high, because this should lead to at least a second leg up and potentially some sort of measured move. So it's possible that we end up getting good follow through for the bulls tomorrow. It's just not super likely, I don't think. The weekly chart forming an inside bar. Bears want a bear bar closing near its low, and if they get it, then a lot of bulls, any of the always in long bulls, are probably going to exit below this bear bar. So bears at least want a bear bar closing below its midpoint, and bulls obviously want to make the week as bullish as possible. So if we don't end up breaking out of the range of the week so far, I'd pay a lot of attention to the midpoint of the week, which is 49.92. Actually, let me get this exact, because it is important. What's the low of this? 49.59.25. 59.25. Then the high of this is 5028.75. Is 49.94. So I would personally I'm going to pay a lot of attention to 49.94 over the next couple of days, especially if we don't break out. It'll be interesting on Friday because we're right around the midpoint now. So traders are going to end up fighting over that close if we don't break out of that midpoint. So that'll be cool to watch on Friday. On the monthly chart, we're starting to get disappointment. You can see there's a tail on this bar. I've been saying I think we're going to get a disappointing bar. We'll see what it ends up being, but I would not be surprised if this bar closed at least below its midpoint, which I won't go through that whole process again, but it's somewhere in here, which I'd pay more attention to next week. And yeah, that's the day.